Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our second September monthly market update. Before I begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So we'll jump right into it. We hope to see many of you in just a few weeks at our quarterly investment forum in October. You should have already received invitations. If you have, go ahead and complete those. If you need one, feel free to let us know. So the long anticipated Fed rate cut happened last week. Perhaps not a surprise, but the Fed went 50 basis points, which was higher than many had expected. That marks the first time the Fed has cut rates in 4 years, since 2020. So the question is, if 50 was a little bit more aggressive than was expected, what is the reason that the Fed cut interest rates 50 basis points? Keeping in mind the Fed has a dual mandate of full employment and price stability measured by inflation. So one of those reasons, and this was mentioned in the Fed comments on September 18th, was a weakening economy. We'll talk in just a second about the July and August jobs reports and some negative revisions. But one of the reasons the Fed cut rates is that the second part of their mandate, which is full employment, has shown some signs of weakening. So this was a comment from last Wednesday, meaning that job gains have slowed, and we have seen that in the data. The other reason the Fed cut 50 basis points was perhaps some progress on inflation. The most recent 12-month print has a 2 handle on it, which means that, again, inflation builds on itself, so it doesn't disregard the fact that in 2021 inflation was 9%, but that the most recent 12-month read is in the mid-2s as it relates to inflation. So the answer to this question as to why the Fed cut rates 50 basis points could be either a softening labor market, or inflation, or it could be both. And we'll see kind of how both of those play out. But clearly the Fed saw either a softening jobs market or a reason that they could make a decision in light of a softer inflation print. And we'll see how both of those pan out. So how do stocks and bonds do following a rate cut? A lot of that depends on whether we get the recession or not. So if we don't get a recession, so this is more of the soft landing camp, the first Fed cut going back to 1966, within 12 months, you've got stocks and bonds both rallying significantly. If you get the first Fed cut and you get an accompanying recession, and interestingly, bonds don't change that much. But stocks are negative over the last 12 months. So one of the big things to follow is, again, whether a recession accompanies the first Fed cut or not. And just overall, as it relates to the Fed cutting, 12-month performance in a mix of assets, generally supportive. So you've got long-term treasuries, growth stocks, large cap stocks, core bonds, again, generally supportive of these assets moving forward in a positive direction over in the 12 months following the first rate cut of a cycle. As it relates to the broader economy, we're still kind of in slow growth, but growth mode, and this is what's projected Q3 and Q4 of this year. However, there are some kind of danger signs. Debt service ratio, which measures how much of a percentage of income is required to service household debt in the US, is now 10%. So it's gone up significantly over the last couple of years. And you see delinquencies picking up as well. So particularly in auto and credit card, you're seeing 8 and 9% delinquencies, which is more than 30 days. So the consumer, which drives 70% of the economy, is showing some signs of weakness. We are seeing earnings for the first time since 22 expand beyond the Magnificent Seven. So again, for the first time in 22, large cap companies ex tech have had positive earnings growth. Now, this broadening has happened beyond the Mag 7, but it is still confined at this point to large caps. Smaller caps on an earnings growth basis have continued to lag. So we're going to take a quick look at the most recent jobs reports. We've looked at these before. 142,000 in August, which again evidences a softening market. It was even softer in July with a revision of this 114,000 down to 89. And the even bigger news is a restatement from April through March of 2024. The jobs were overstated by over 800,000 over this 12-month period of time. So going back to the original question of why the Fed cut 50 basis points, we have seen the jobs market soften significantly, which is perhaps one of the reasons why the Fed went ahead and cut a larger than some had expected amount at 50 basis points. This is kind of the other read, which shows, again, a two handle on the inflation number. So over the last 12 months, inflation headline is at 2.5, and core, which excludes food and energy, at 3.2. We have seen volatility pick up from mid-July through early August. We saw a significant decline. Part of that was what was happening in Japan, and part of that was a very weak July jobs number. But we saw the S&P go down, technology stocks down by almost 15%. But what's interesting is, as quick as they went down, they kind of shot right back up starting in early August through the end of August. So, but again, a lot more volatility, throughout the summer. And interestingly enough, we saw the VIX declined 58%, 38 to 16 over 7 days that ended mid-August, which was the largest 7-day volatility crash in history. So again, a lot of volatility both in both directions, both down and up, in the kind of late July to mid-August timeframe. We also have other news on yield curve inversion, or I should say uninversion recently. So for the last roughly 800 days, the yield curve has been inverted, which means you've been paid more on the front side or on the short side than you have on the long. That just uninverted in August. So kind of what that means as it relates to market. Again, yield curves inverted are typically a good indicator of a forward recession. Again, we're 800 days in until it uninverted, and we haven't had the recession yet. And we're still kind of waiting to see if that's going to happen. So some updated reasons for pessimism and optimism. Again, on the pessimistic side, based on a weakening jobs market and a weakening consumer, we do get the long anticipated recession. The Fed cuts interest rates less than expected. Again, this risk has mitigated because the Fed did cut rates last week at 50 basis points. Geopolitical risk and U.S. debt level risk remains high. Earnings have broadened out a little bit, so that's an encouraging sign. And regardless of the outcome, election year, we're some 50 days away, will be past us, and the markets can think about what to respond to in 2025 and beyond. But until we're through the election, there's a reason for added volatility between now and then. Now, on the optimistic side, we continue to get a delay in the recession. Inflation is lower, and we have seen that happen. The Fed has cut rates now, so this is kind of moved a little bit more towards the optimism camp. Performance is wide, and we've seen that specifically in large cap. Earnings have been good, and we get through the election without any other elevated risks. So reasons for optimism and pessimism. We will be sending out trade notes soon regarding an updated rebalance. I will talk just briefly about some themes that you'll see reflected in trade notes, where you'll see a lot more detail for our upcoming rebalance. The first thing that we'll be accomplishing is just a return to target. So equities have done well since we last rebalanced. So we'll be selling that excess and get back to a closer to target amount on the equity side. We will retain our cash overweight, but less so. So we'll be reducing our cash overweight as money market rates will start to decline as the Fed raises interest rates. We're going to reduce somewhat our dollar-denominated exposure. We're going to retain overweights to these three areas, but in a reduced way. So we'll still be overweight US growth and large cap, but less so than we were in the last rebalance. We'll also be reducing our energy exposure. Energy, having that concentrated position in a lower inflationary environment isn't as valuable a risk hedge. So we'll be reducing that exposure, and we'll be reducing small cap exposure as well. Small cap has been in an earnings recession since 2022. And it's just the wrong place in the cycle. So we'll look for us reducing that position overall. So none of this is a replacement to contact us directly as to how all of these things apply to you. So if you have any questions about anything discussed, please let us know. We hope to see many of you at our quarterly investment forum next month. Again, if you hadn't signed up for that, please do so. So with that in mind, we'll close. Again, we want to thank you for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. We're here to help. So if you have any questions, please let us know. Until we see you again, hopefully at our forum next month, be well and take care.